Hi and welcome. My name is Alex Melconian. I'm joined today with John Ekmekdjian from TD Bank, mortgage specialist. And today we are talking about refinancing and mortgages. But before we do, I want to announce today is June 5th, 2024, and the Bank of Canada just announced a quarter-point rate reduction, which is exciting. It shows stability. It shows inflation is coming down. And since we have John with us today, actually, I'm going to ask you for your insights. So John, share with us, what does that interest rate cut mean?
Some big news. First a couple of years, we're getting a cut. So
very excited.
It's a good sign. It's a small cut. It's a quarter point, right? Brings us down to 4.7% on the rate. But it's a good sign moving forward that we're moving in the right direction. Like you said, inflation seems to be coming down over the last couple months. Bank of Canada is starting to kind of loosen up some of the fiscal policy, and hopefully this is a good sign for things to come with more rate cuts down the road.
And that, that's a relief for a lot of us out there.
Absolutely.
The reason I asked you here today is actually, I wanted to know, why do people refinance? What are the benefits to refinancing? What are the costs involved?
Based off kind of my clientele, there's three major reasons why people refinance. I can go through a few of them here. Main one, and most importantly, most common one is an equity or cash takeout, what we call. So lots of people have bought their homes a few years ago, maybe a couple decades ago, who knows, and they've built up quite a bit of equity in it with the values going up. They've paid down their initial mortgage, whatever it might be, and there could be, who knows, $1 million or more of equity sitting in that home. And really the only way you can access that and get your hands on some of that turn into cash is either to sell, which a lot of people don't necessarily want to do. So the other option is to refinance. So you're going to refinance and you're going to take out cash either for, let's say, to buy another property, you're looking to buy a rental, or you might be looking to buy a property for your child, your son, your daughter, whatever it might be, or a family member. That's a great way to actually access that cash and use it for that.
So that makes perfect sense to me, actually, and I'm an example of that too. I had purchased a condo investment back in 2011, and not too long ago we actually refinanced, pulled some of that equity out, and we used that money to renovate our home.
Exactly. So that actually brings me to my second point there. A lot of people do the cash and equity takeout to do renovations, either before you sell or even just for your own lifestyle. Some people renovate their rental properties to maybe get a little bit more rent, or it might be the home that they live in, they need to update their kitchen, washroom, put on a second level, whatever it might be. That's a great way to access that equity and use that cash. In this scenario, you're not really losing much as well because the value of your home goes up as well when you renovate it in most cases.
That makes sense, yeah.
So that's a great thing.
So number one is to pull out equity from your property. Okay,
Exactly. Second, not as common, but it has been common the last year or two because of the higher interest rates that we've talked about, is called a re-amortization. So we've had scenarios where people have been paying at 1.5% or 2% interest rate. Their payment's been $2,000 or $3,000, for example.
Yeah, that was good times.
Those were good days. Those were good days. Hopefully we're going back soon. But when they come to their renewal time, they're getting shocked at what their payments have gone up to because of the rates. So a way to kind of alleviate some of the pressure and kind of ease your budget in your bank account is to re-amortize. So say you got 15 years left on your original amortization, your payment would have been now $5,000 a year with the new rate. Instead of that, we do a refinance to re-amortize that 15 years back out to the 30 years that maybe they originally started from.
Okay.
This way you're spreading your payments out over 30 years instead of 15 years. You're going to get a much lower monthly payment. It's going to be much more comfortable for you in your bank account.
So we're extending that mortgage life to bring down our monthly payments.
Exactly. And
that makes sense.
And a lot of people do this. You could keep that lower payment, but if things do happen where the rates do come down or you get a raise, whatever it might be, you can always find ways to bring that amortization back down by making lump sum payments into your mortgage. And you can also, with TD, double your payments every month, and all of that would go to principal, essentially bringing your amortization back.
Okay, so the second reason is to extend the mortgage for lower payments. Right. So what would be another reason?
So another reason very common here is called a debt consolidation. So you have a mortgage and you also have line of credit, maybe 2 credit cards, maybe a car loan, maybe your son or daughter just finished university or is going to school, and you've racked up some debts because of these things. You can actually consolidate those debts on a refinance where we pay out all of those debts and consolidate that into your one mortgage. So Your overall interest is going to come down because mortgage rates usually tend to be the lowest interest that you're going to find out there in terms of rates, as opposed to line of credits or credit cards. And also your payment, instead of say doing 200, 500, 200, 400, you can consolidate them all into one easy mortgage payment of say 700, for example, you know, instead of making all these separate payments.
Well, that makes sense to me. I mean, why you're paying off credit card here, you're paying off line of credit here, you got a mortgage here. If we just blend them all together, and you're making one payment, and does that affect your credit score at all?
So in a way, it would help your credit score because you're not going to get behind on your payments. You're not going to have high utilization of all your other credit facilities, which tends to usually affect your credit score negatively. So this is a proactive way to make sure that your credit score stays high and maybe even increases over time for further use.
Let me ask you this, John. How much does this all cost? Like, how much does it cost to refinance?
Great question. So this is something that I always go over with my clients. First and foremost is the costs. It's nothing too bad. There's a $300 appraisal fee. Anytime you do any mortgage, a refinance, of course, as we've already established, is a form of a mortgage. So anytime you do a mortgage or a refinance, we need to appraise the home value because you can go up to about 80% of the home value in borrowing. So we have to make sure that we know what the value is. That's a $300 charge for the appraisal. And then the second part is the legal fee. So when you register a mortgage initially, usually a lawyer does it for you. Charge anywhere from $1,000 to $2,000 to register that lien on the home. So when you're going to be asking for more money, there's a chance that we're going to have to increase that lien. So there's more legal fees. You could potentially go through your own lawyer, and their charge is whatever they charge. That's between you and them. But TD does have an in-house legal team that takes care of these, the $650 charge. These normally you can either pay them upfront or you can put that into the new refinanced loan.
That's a great option. So use TD in-house and you could save some money.
Exactly.
That's great.
Also, very importantly, I do want to mention that there's two separate ways, or two products, I guess, two financial vehicles you can use for a refinance. One is your standard mortgage that everyone knows about, term reducing. You start off with X amount, you pay it down until it's done. Second option, which has become very popular over the last few years, is called a home equity line of credit, also known as a HELOC, and TD's product is called a flex line because it's very flexible. It's like a line of credit, and as you pay that down, it becomes available for you again. So it's re-advanceable. You can use it again and again and again. There's no expiration date. It's until you either sell your home or you decide to close.
Oh, I understand. So as you're making monthly payments, you're also getting more access to credit.
Right. So as you're paying down your principal, that becomes reusable.
Right. Okay, that's great. John, thank you so much for sharing all this information with us. I found that really insightful, and I hope you did too. If you have any questions, you can contact John at the link below, or his contact information will be available on this video, or you can leave a comment on this channel. Thanks so much for watching, and thank you so much, John.
Thanks for having me, Alex.
Appreciate it.